Okay, folks, welcome to a very special Christmas edition of the Week Ahead Commentary. This is going out to all of our newsletter subscribers. And just to set expectations here, what we do is we review the weekly charts on a closing time frame, and we talk about what to expect in the new trading week. And in this case, we have the end of the month here, and we're going to be looking out into Q1 and how we want to be positioned in this market. Now, before I forget or you log off early, I want to wish everybody a very Merry Christmas, Happy Hanukkah, and a Happy New Year. What we do normally on the Week Ahead Commentary is we begin with the bond market. We talk about how bond yields are doing, how they may impact equity prices. So let's get to it. Let's begin with the 10-year yield weekly time frame. And last week, we saw a significant move higher in the 10-year yield. We were in a bull flag setup. We had broken down, but that breakdown, there was really no follow through to the downside, and we have now recaptured support, and we are now proceeding up towards the upper band of resistance. Now, some might view this as, well, the economy is improving, yields are moving up higher. That's not how we see it. And I'm going to pause here because we're going to be talking about this on not Sunday Night Futures Live, but Monday Night Futures Live. We're going live on Monday as the markets are closed on Monday, so there's no sense in going over futures actions on a Sunday night. So Monday Night Futures Live, 6 p.m. Eastern Standard Time. Back to bonds. We don't want to see rising bond prices because they are very negative for technology stocks in particular. And why is this yield moving up higher? Well, the Congress just passed another $1.7 trillion worth of pork, and that's going to need to get financed. You have a Federal Reserve that is rolling off debt off their balance sheet, so if they're going to keep to their promise that they're going to continue to roll off that debt, well, it's going to be up to the free market to absorb these treasuries that are going to hit the market. We have an inverted yield curve. So they're going to need to pay up on that long-dated paper to finance the debt. So we're being sold out by our Congress, our own government, and expect that this might be a short-term catalyst to the upside in certain cases, such as defense stocks. They'll do well. But overall, this is going to result in a rise in inflation, rise in yields, and a weakening of the U.S. dollar, thus exacerbating the pinch from inflation. Moving on to bond prices. So the TLT, which had broken out above the upper band of resistance, has now failed. It is now broken back down below what was support, or was to have been support, is now resistance yet again. So the bear market in bond prices is alive and well. Now, this all being said, I think that we need to keep an eye on the TLT. Why? Well, we believe that this market is not done going down. So what benefits in a declining market? Well, you should expect to see some money rotate into the bond market. Now, this has not been the case in 2022, where usually if you have money leaving the equity market, you have money flowing into the bond market. So while historically, I don't expect that to change on a year-over-year basis. You never know. So we're going to keep a close eye on the correlation between bonds and equity prices. In fact, we're going to make that a topic to go over on Monday Night Futures Live. We're also going to be talking about the correlation of gold versus the S&P 500, and now how gold is outperforming, and how gold mining stocks are vastly outperforming both the S&P 500 and gold itself. And we have core positions in the gold mining stocks, gold, silver, as well as emerging markets, which we'll talk about in a moment. Now, with an aggressive Federal Reserve, you would expect pressure on the tips, and that pressure has resumed over the past several weeks after a brief multi-week rally. Our momentum indicators, stochastics, are rolling over, as well as RSI. We are holding support. So maybe we'll get a higher low here. We don't know. We're not that smart. The markets are going to tell us. The dollar. Weekly chart. This is the dollar bull ETF. We have stopped going down. That's the first milestone to reach prior to any type of a rally. And whatever you're trading, you have to stop going down. Even though last week was a down week, we did not have a new weekly lower low, and it was a second consecutive week of bottoming action, showing that we have support at the 27.75 mark on the dollar bull ETF. Now, to see whether or not any rally here is going to have legs, we need to take a look at the euro first, weekly view. The euro makes up 55% of the Dixie basket, which trades against the US dollar. And you can see the week prior to last, we had some real serious topping action after a massive rally off the lows. And last week we had a doji formation. That's a sign of indecision. If I had to wager a guess here, I think that will, in all probability, consolidate sideways with a bias to the downside, creating a downward sloping handle. And we may then get a continuation move higher on the euro dollar, not the euro dollar, euro. So my guess is that any rally in the US dollar is going to be brief. Now moving on to the yen, which we really don't talk about all that much because not much changes over there. Well, a lot is changing over in Japan. And this is going to cause problems for the US dollar. This is the second largest component of the Dixie basket next to the euro that trades against the US dollar. So when these two rise, euro, yen, dollar goes down. So last week, it was announced that the Bank of Japan, the BOJ, did a surprise overnight rate hike of a 0.5 percentage point. And this is on the heels of them saying, this is not the Bank of Japan, it's the government of Japan saying, while they're going to expand on their defense spending, they will not be floating debt for defense spending. They will be raising taxes. That strengthens the yen even further. There may be signs of fiscal discipline over in Japan, and that does not bode well for the US dollar because the last thing that we are here is fiscally disciplined. The VIX, if you could believe it, the VIX was down yet again last week, down around 7.75% daily view, a bearish reversal bar on the session on Friday. Now, I'll tell you, when you see a day like this, where you have a bearish reversal bar, if the VIX rallies up and through this upper band of resistance next week, that is a huge, huge event because the probabilities historically are that when you get a long red candlestick like this, you're going lower. But that didn't happen here on the 21st. We reversed the next day. So keep an eye on the VIX. While it looks somewhat bearish, I'm skeptical of this bearish price action. I'm worried about a higher low and then a potential breakout. If we get a close above 25.84, you better have hedges on in this market. You better have a sizable amount of cash on the sidelines. And even though we own gold stocks, I have no delusions of grandeur that they will be spared selling because they are liquid. They will be sold. But that sell-off is to be bought. We're going to talk more about hedging our gold stocks in a minute. So stick around. The Dow transports, they broke down last week, folks. A real serious breakdown. Let's update this. We always talk about the Dow transports being our canary in the coal mine for equities. And we broke down not just below one support level, but two last week. The transports are in big, big trouble. Daily chart. An update on Friday, and I hope that we get a continuation rally. And I hope we get a continuation rally across the board in this market because on that rally, we are going to be looking to put on some real serious hedges. Probably put options on the S&P 500, if not the small caps, and quite possibly the triple Qs. So good price action here on Friday. Obviously, volume was very, very light, and I think that's going to be a theme that Friday was light volume. The Dow Jones Industrial Average, they closed up on the week last week, just over 0.75 percentage point on volume. That was just below average, no great shock. This time of year, very little volume. Daily chart, bullish key reversal bar. We have resistance immediately above. I would not say buy the Dow Jones here. And if they do rally it up and into, say, 33,750, and the S&P 500 follows suit, we're going to be looking to short the entire stock market. The S&P 500. Weekly view. Down fractionally on the week. We did close well off the lows of the week. The final 2 weeks of the year are seasonally favorable, with the final week being most definitely the most historically bullish week of the year in terms of seasonality. Daily view. We closed up over a half percentage point on Friday. Bullish reversal bar, consistent with the Dow Jones on light volume. I'm going to stop saying light volume so I don't keep repeating myself. Expect that most of these charts will have light volume for Friday. I will point out any up volume bars, though, which would imply accumulation. Qs, weekly view, down over 2.25%. Very bearish price action here. Clearly the laggard of the major indexes that we use. Daily view. First thing that strikes me, and this is the same for the Dow Jones and the S&P 500, Stokes making lower highs. Reversal bar to close up on Friday. The banks, an up week last week, up 1.37% on light volume. Daily view. Good consolidation here. The banks like rising yields. If the S&P 500 does make a move up higher, expect that the banks are probably going to be the leaders of the group with rising yields. Technology. RSI continues to trend lower. Stokes rolling over. We had a little bit of a bounce last week. You can see that the 50-period moving average is acting as your overhead ceiling, and that ceiling is declining. So whenever you see a move up and into it, that is a signal to short technology. I'm reluctant to do it here. I want to do it on strength and into that resistance level. Semiconductor sector. A down week last week, down 3.65%. Very light volume, though. Daily view. A bit of a reversal bar, but they couldn't close it positive on Friday. LABU. We own LABU for full disclosure. Weekly view. Not looking good here. Stokes are rolling over. Struggling to break out above resistance. So I wouldn't go adding any more here. I do love the RSI cup with handle formation, but the stochastics rolling over, a major concern, and the fact that we have not had the rocket fuel to hold on to this resistance level is concerning, to say the least. And we are now trading down below the lower band of support. Consumer staples. One of the bright spots on the week, I really like this setup there. Not all that far off their all-time highs relative to the rest of the market. Bullish reversal bar. This is where money's flowing. We held support. We had broken down the prior week. We held it last week. Very thin volume. Daily view. Good price action. Is this a bear flag setup? Quite possibly. You can see how easily they move the market. Take a look at this volume bar. Very, very light. But they moved this index by over a half percentage point. I should say ETF, but it is an index in a way as well. So here is the lower band of your bear flag. Here's your upper band. And this can continue. Consumer discretionary names destroyed last week. Folks, this is what the market is going to look like not too long from now. Might we get a counter trend rally? Sure. But consumer discretionaries are screaming. The consumer is dead. Long live the consumer. They broke down to multi-year lows last week. Forget about the pre-COVID spike up higher. That's in the rearview mirror. This was the breakout back here. We are now below that support level. Daily view. A reversal bar on Friday. Not much to talk about here. Might we rally? Sure, but I think that rally is to be sold. The next chart up, emerging markets, EMXC, weekly view. Now, this is one of the sectors, emerging markets, ex-China, that we're going to be looking to build on aggressively in 2023, because I believe that the first half for domestic equities is not going to be a good half. The yield curve, which we're going to be talking about on Monday Night Futures Live, is screaming recession. We have a Federal Reserve which is promising additional rate hikes into a recession. And it's a recession that the media refuses to acknowledge. 2 back-to-backs of consecutive negative GDP is the textbook historical definition of a recession. They have literally, the government has literally changed the definition, and the media is carrying water. And that kind of delusional behavior is going to come back to bite in a very, very hard way. So we choose not to go through life with blinders on. We live in Realityville. So we know that domestic equities are very expensive, whereas emerging markets are very cheap. Why ex-China? China's corrupt. And if we go to war, what happens with China? Or if they do something we don't like and we start sanctioning them, they could freeze Chinese stocks that are trading in the United States, just like they did with Russia. And if you're trading EEM or EDC, which is the leveraged version of EEM, that's 30% China. Think about it. That's a 30% haircut overnight. We choose to avoid that. So EMXC, it did very well last week, up over a 0.5 percentage point versus the EEM, which was down on the week, folks. So clearly, it's better to be in emerging market funds ex-China. Energy. Energy had a really good week last week. We had shorted the emerging markets. We had shorted energy several weeks ago. We booked profits. That was right here on this big red candlestick. And I want to re-short this. And it's not because I'm bearish on energy per se. I want to short a sector that, if in fact the powers that be acknowledge that we are going into recession, well, or that we are in recession, energy stocks may take it on the chin. But you need to watch oil. If oil rallies, so shall energy. They're very tightly correlated. They lost that correlation. In fact, here it is, XLE versus USO. You can see how they were tightly correlated, almost between 75 and 100% of the time, and that correlation fell apart as the president dumped oil out of the strategic petroleum reserves. The markets knew that was a finite event, and they did very little damage to the energy stocks. And I do believe that that dumping is over, and oil, which we're looking at here, is moving back up yet again. So is it time to short emerging, I keep doing that. Is it time to short energy stocks? No, not with oil threatening to move up higher. We're up, wow, big move, almost 7% last week. Daily view. Love the momentum indicators. Price action, a little bit toppy here. We have resistance immediately above. Gasoline prices, another nail in the coffin for the consumer. A big move up higher last week. Over nearly 11.5%. Think about that. Gasoline prices spiked nearly 11.5% in a single week. And when did they do that? What day? No great shock. On Friday. What happened overnight? They passed in the Senate that pork bill. Billions in that pork bill to defend the borders of several other countries. Not one single penny. Not one single penny to go for protecting our borders. Gold. Now, we're going to be talking about this a little bit more on Monday night. But I'm not loving this chart. I've been critical of gold at times, even though I'm a bull. And I was critical all during this down push. We recently turned bullish on gold. We were buying physical when we began to bottom out. But these topping tails here and the inability to close it above its 50-period moving average at 18.07 the ounce is concerning. Now, what might get me off the sidelines, I'll tell you, if they push this through and they close it above 1850 with no pullback, that means that you have a big whale, or whales plural, buying up gold because they view it as cheap, and it is cheap. And I think this is going to be the play for 2023, along with the gold stocks, of which we are long. Now, gold stocks last week, I mentioned this earlier, they have been outperforming gold and the S&P 500. Whereas the S&P 500 was down last week, the GDXJ, which are your junior miners, they were up over 3%. Daily view. Oh, by the way, this chart is extremely bullish. RSI, higher lows. And I know some of you may be out there saying, oh, the stochastics are above 80. It's overbought. Don't go by that. Look at when they were oversold down here, and the shares kept getting hammered. You could be oversold for extended periods of time, and you could be overbought for extended periods of time. Worry about when the stocks are rolling over and putting in lower highs and lower lows. That's the problem. And we don't have that here. So nice orderly consolidation, multi-week consolidation, holding 34. Now, on any rally here, we are going to be selling covered calls. Why? It's because we know that from history, once you get a major correction in the market and the yield curve beginning to steepen, initially gold stocks, silver stocks, they go down along with the rest of the market. Why? Margin calls. People are forced to sell whatever they could sell. Despite the future prospects, despite how cheap they may be, people need liquidity. Daily view. Really nice setup here. Nice consolidation. Note the 50-period moving average in blue is rising relative to the 20-period moving average, 200-period moving average in red. And it looks as though you're going to have a positive crossover of the 20-period in green above the 200-period next week. Nugget, weekly view, a powerful consolidation here. We broke out of this downtrend several weeks ago. We have retested, we have held, and it looks as though we're getting ready to move up higher. Silver. Silver's had a heck of a run, and on the week it was up even more than gold, up more than the gold mining stocks, up 4.42%. Now, this is a leveraged ETF. Now, silver did close up 2.25%. Still better than gold, not quite as good as the gold mining stocks. Our silver mining stocks, weekly view, they were up 1.32%. Bullish key reversal bar on the week. These are looking very, very good. Look at the volume. Look at this volume. This is the only chart so far that we've had volume above average last week. This speaks, pardon the pun, and the pun is intended, this speaks volumes. That's institutional accumulation, daily view. Bullish key reversal bar recaptured 200-period moving average on Friday. Volume was weak on Friday. Gold money. This is our little penny stock play on gold. And they were down on the week. So not much to talk about here. We'll hold on to it. Uranium, weekly view. Bounced off of the lower band of support. This is looking really, really good. The only thing I don't like are these stokes. They continue to put in lower lows. That is very much concerning. However, that being said, if you're not long of uranium and you like this setup, fine, scratch the itch here. Use a stop loss right below the lows of last week at $19 a share. New trade, Boyle. We were involved with this one. We booked our profits. We got out of the way because it tanked. It's probably going to tank lower. We sold puts at the 15 strike. Look at the volume here. daily view. Now, they put up a little bit of a defense at 20 on Friday, but still a ton of volume. And this is on Friday, a lot of volume to the downside. Let's see if that's Boyle specific or Nat Gas specific. Let's check out UNG, which is the ETF. Now, Nat Gas, UNG, I should say, and Nat Gas, obviously, was up on Friday on volume. Look at the volume here. That's a tell. Tesla, we are of a options trade on Tesla, and we are also long of some common. And we did a couple of day trades last week on Tesla. We don't do a lot of day trading at all, but we saw opportunity here, and we made some money there. There's still a ton of institutional distribution here. Do they want to get this selling done before next week? Possibly, so they can go on vacation. Now, we're going to be looking to add more to our position. Why? RSI is now in, air quotes, extreme oversold territory. We are below 20. It's rare that you get a stock like Tesla with RSI down below 20. That doesn't mean it can't go lower. Stokes are like a coiled spring. I'm telling you right now, when this thing rallies, it's going to be a rip-your-face-off rally. And we could quite possibly move up to 140 to 150 on Tesla. But it's to be sold. I don't think that we've seen the lows here. Now, what I'll be looking for before we add more to our overnight long position is volume, which is declining and ideally below the moving average. Ideally, we take a look at our MACD histogram, and it is leveling off, not continuing to put in lower lows. We want to see it flatten out and begin to put in higher lows. And ideally, we get a double top on ADX red. So we're close to a bottom here, but that doesn't mean we're not going to feel more pain first. Let's go to a 30-minute chart. Yeah, 30-minute chart. Clearly, RSI, there is no bullish divergence. Stokes, no bullish divergence. They are following price down tick for tick. It was a weak close on Friday. That leads me to believe that we're going to see lower lows going into the new trading week unless those institutions are all done selling. And be very, very careful about spikes up either pre-market or at the open. They did a lot of spiking of Tesla on Thursday evening after Elon Musk announced that he would not be selling any more stock until 2025. That faded real quick. So that just tells you institutions were laying in wait. Now, what do we want to see? Back to the daily chart. What do we want to see for us to go adding more and carrying overnight? We need to see a bullish reversal bar like here. Last seen on July the 5th. What did that lead to? A massive rally. That's a sign of sellers trying to take the shares down and bulls not having any of it anymore. And they bid the shares up, thus creating a short squeeze. And short interest has been moving up on Tesla. And with that, folks, remember, no Sunday Night Futures Live this week, but we are doing Monday Night Futures Live. Everybody have an awesome Christmas. And if you're not currently a member, please take advantage of our 14-day free trial offer. Take care. Be well.